The NASDAQ is closed, so we're looking at the last recorded price for AST SpaceMobile Inc., which stood at $61.40 per share, marking a fractional decrease of about 0.07% for the day on Friday, November 14, 2025. Now, the common expectation for ASTS is that it's a high volatility, pre-revenue speculative play, a binary bet on whether they can actually deploy their space-based cellular broadband network. That narrative is tired and misses the crucial point. The market has fundamentally repriced the risk on this stock, not just on the potential, but on the execution funding. When you look at that third-quarter earnings report, the headline miss on the $22 million analyst revenue estimate, reporting $14.7 million instead, should have been a disaster for such a growth-fueled name. But the stock's reaction was measured because the company has successfully secured its financial runway for the near term. This suggests a subtle but important shift in institutional confidence, moving from merely believing in the idea to believing in the capability of the management team to secure the immense capital required to execute it. This is the tension between expectation and reality here. The market expected a clean revenue beat to justify the hype. The reality is that the real victory was the financial de-risking and the significant partnership expansion, which is arguably more valuable at this stage than hitting a small revenue target driven by government contract milestones and gateway deliveries that are inherently lumpy and subject to delays. The recent stock movement for ASTS has been a textbook example of a speculative, yet strategically well-placed, technology company battling for its footing. The stock has seen a massive surge year-to-date, up nearly 200%, but this game has been punctuated by violent swings. We saw a powerful rally peak around mid-October, followed by a sharp retreat of over 30% in just a few weeks. This volatility is not random. It is directly tied to a sequence of high-stakes announcements. The news about the successful completion of the Bluebird 6 satellite assembly provided a huge thrust, followed by the strategic commercial agreement with Verizon for connectivity across the continental United States. These are exactly the kind of concrete developments that retail investors and even high-risk, sophisticated buyers, including those using platforms like Robinhood for quick access or more comprehensive tools like interactive brokers for detailed analysis, latch onto. The belief is that these deals validate the technology and the business model, translating to future, enormous revenue streams. However, the pullback was triggered by an analyst double downgrade, which cited an excessive valuation and the announcement of a large convertible notes offering. The market, as it often does, priced in the short-term pain of potential shareholder dilution and a fresh look at the competition from behemoths like Starlink's stock competitor and space veteran Elon Musk's Starlink, forgetting for a moment the long-term strategic advantage that the capital provides. The volume in the last trading session was around 10 million shares, slightly below the average, which suggests the volatility of the mid-October spike has stabilized, and the stock is consolidating around this $60 to $65 level, which is a key technical area. It's an important detail that the trading platform used for such transactions, whether it be a simple app-based system or a more institutional one favored by those doing self-investing, has seen this massive volume, proving the high-interest nature of the stock. The institutional activity is what truly underscores the expectation versus reality dynamic. Short interest remains elevated, sitting at around 16.4% of the float, representing about 4.5 days to cover, which is a significant figure that contributes to the stock's potential for explosive moves. This high short interest means that a large portion of the market is actively betting on the company failing to execute or on the valuation being unjustifiably high. Simultaneously, you have major institutional players building or maintaining positions, effectively taking the opposite side of that trade. This duality is what creates the significant daily price swings. When good news hits, the short covering combined with new institutional buying creates a short squeeze scenario. And when negative news or a large capital raise is announced, the shorts press their advantage. For those who use services like Schwab Intelligent Portfolios, this stock would likely fall outside their automated asset allocation due to its risk profile. But the underlying tension is fascinating to watch from a broader market perspective. The large cash position, stated at over $3.2 billion in cash equivalents, restricted cash, and liquidity, pro forma for the convertible notes offering, provides a massive shield. The expectation is that a pre-revenue satellite company would be constantly strapped for working capital. The reality is that ASTS has been shrewd in its fundraising, effectively buying itself a 2 to 3 year window to execute its constellation deployment, without the constant fear of needing a dilutive emergency cash infusion. That war chest is the real stabilizer, keeping the stock from collapsing back to its 52-week low of $17.51, despite the recent earnings miss. Now, let's talk about what AST SpaceMobile actually does, which is essential context for understanding the long-term outlook. They are building what they claim is the first and only space-based cellular broadband network designed to connect directly to standard, unmodified mobile phones. Think of it as a low Earth orbit satellite constellation, the Bluebird satellites, acting as massive cell towers in space. The promise is to provide connectivity to the 5 billion mobile subscribers in areas where terrestrial cell towers don't reach, eliminating the significant connectivity gaps. Their technology is distinct because it doesn't require a special satellite phone or an external device, unlike some competitors. This capability to directly connect to an existing smartphone is the core intellectual property, and the reason major mobile network operators, including AT&T and Vodafone, have signed to commercial agreements. The business model is simple in concept, though complex in execution. They act as a network of networks or a capacity provider, selling access to their space-based cellular broadband to these existing mobile network operators. The revenue model relies on recurring service fees, and the recent revenue of $14.7 million, while a miss on analyst expectations, represents the first tangible signs of income from gateway deliveries and U.S. government contracts, marking the transition from pure R&D cost center to a verifiable source of cash flow. Past performance on the stock has been extremely volatile, characterized by large run-ups on technical milestones and sharp pullbacks on funding or valuation concerns, which is typical for a company in this capital-intensive pre-commercial phase. Looking forward, the tension between the ambitious goals and the massive technical and regulatory hurdles creates the future narrative for ASTS stock. The expectation is set by the company's aggressive timeline. They are on track for 5 orbital launches expected by the end of Q1 2026, with a long-term goal of 45 to 60 satellites by the end of 2026. This is the reality investors need to focus on. Can they maintain this aggressive launch cadence? Any delays in satellite production, launch schedule, or regulatory clearances for their proprietary ASIC technology could lead to another significant correction in the stock price. The catalysts for the next upswing are clear. Successful on-schedule launches of the Bluebird satellites, specifically the Bluebird 6 and 7 launches expected in late 2025, and the announcement of commercial service commencement, even if intermittent, in key markets like the continental U.S., Canada, Japan, and the UK in early 2026. These tangible steps would move the company from a technical potential story to an active commercial enterprise, validating the enormous valuation premium it currently holds. However, the risks are just as profound, and this is where the reality check comes in. The valuation, trading at a price-to-book ratio significantly higher than its peers in the telecom industry, clearly price in near-perfect execution. This makes the stock highly sensitive to any misstep. Competition is intensifying, not just from the usual suspects, but also from the speed at which players like Tesla stock competitor and space veteran Elon Musk's Starlink are moving into the direct-to-cell space. While ASTS technology is fundamentally different in its approach to using unmodified phones, the battle for spectrum priority and commercial agreements with carriers will become increasingly fierce. Furthermore, the sheer scale of the space build-out, along with the need for continued funding, even with the recent capital raise, means that the shadow of dilution is never fully gone. Investors need to be aware that buying ASTS is not like purchasing shares in established players that offer online investment strategies, mutual funds, or Fidelity ETFs